How's it going, everybody? Welcome to Trading Mindset, the weekly crypto trading stream coming out of Bybit. Comes out every single Friday. At least for me, it might be early morning Saturday for some of you guys. But we're going to get started in probably about 1 minute, maybe a minute and a half. I'm going to let a few more people join the stream, do a couple introductions if you haven't been a member of this stream just yet. How's it going, Jeffrey Newbie? I'm doing all right. How are you? How are you guys doing? Good morning, good morning, good mornings all around. Just a little introduction. If you haven't joined the stream in the past, basically what I do, or the format is, we run through a nice presentation that covers a few of the major tenets of trading. We go through either a strategy or an indicator or just a theory. Today we're going to actually be going through Dow Theory and then the psychology, of support and resistance and of candlestick formations. We're going to do all of that on the stream today, and then we're going to end it with some nice chart analysis. If you guys have any requests for specific coins or pairs, we will do those as well. We have a couple requests that are still left over from the end of the stream last week that I didn't actually get a chance to cover, and those were AVAX and XRP, I believe. Good morning. Is it Yasser or Yasser from the Dominican Republic? What time is it there? I'm currently in Austin, Texas. It's just about 11 a.m. here, but let's go ahead and get started. Any other questions? I want to see how candlesticks, I want to see candlesticks with RSI. We can show that on the chart at the end of the stream as well, or at the end of the presentation, but I do want to go through what we have so far. So let's go ahead and bring this presentation up. And if you do have any requests, you can either drop those in Discord or just drop them in the comments. I will see them a little bit better if you just drop them in the comments on the stream. So let's go ahead and get started with the trading mindset presentation. Let's do it like this. So this is Trading Mindset. My name is Brandon Zayats with the Bybit YouTube team. Let's go ahead and get started. 11:52 a.m. In the Dominican Republic. Not bad at all. That's pretty good time difference. So quick disclaimer, we always have to do this. This presentation should not be interpreted as financial advice or an investment recommendation. Trade and invest at your own risk. That should be a little bit obvious. If you've been trading already, you probably understand that there are a few risks to trading. I'm actually going to change this up real quick so that you guys can see the full page. So the first thing we're going to be going over in this week's stream and this presentation is going to be something called Dow Theory. So if you're thinking Dow, you might think, have I heard of that related to the stock market? So there's actually a man named Charles Dow who published a bunch of editorials throughout his lifetime. I believe he was born in the 1850s, died in somewhere around 1902. But between 1900 and 1902, people actually began collecting his editorials and forming it into what is now called Dow Theory. And it's very common, very popular, and well known within technical analysis, stock market trading, and anything to do with trends and cycles for coins and charts. Really, it was based off of stocks and stock market indices. So Charles Dow and a guy named Edward Jones were really the big guys for Dow Theory and for those first stock market indices. You probably heard those names from Dow and Jones, the DJI, or the Dow Jones Industrial Indice. So this was actually formed in the early 1900s, I believe, maybe even, I think, like 1896. So the very end of the 18th century. Am I saying that right? 19th century. And it was actually 9 railroad stocks, 1, let me get this right, steamboat stock, and then 1, what was the other one? 1 telegraph stock. So 11 stocks that formed an industrial average or an indice. And people could use this average in order to get a general idea as to the health of the economy, the health of the stock exchange. We still use these indices to this day. The very common ones are the NASDAQ, still the DJI or the Dow Jones Industrial, the S&P 500. They're all indices that cover an average of many, many stocks, especially for something like the S&P 500, the top 500 stocks, or the NASDAQ. A large group of stocks all average together to create a price that we can track over time and determine how well the economy is doing just in general. Good morning, everybody else joining in late. I'm trying to scroll down and see these new comments. Good morning, good morning. So Dow Theory is the modern foundation of technical analysis, although Charles Dow himself never actually coined the term Dow Theory. It was coined after his death And after all of his editorials were kind of put together and formed into this theory, he also never assumed or never expected Dow theory to be used as a trading strategy. He just used it because he wanted to track how the economy was doing and how his industrial average was doing. It was never for trading, but now it has a huge and very important application within trading. Some major tenets that I'm about to go through that really cover how the cycles of a stock market look, and basically tenets that you can break them down into. So first, the first number one tenet is that the average discounts everything. And by average, he does mean his indices. So think S&P 500, think NASDAQ. The market already reflects every knowable factor that affects supply and demand. So I've actually heard this a lot, and you hear this a lot with stock markets, traders, or maybe even people that are against stock market trading. They say that the market already averages everything out, and you can't really have an alpha, you can't really have an edge on the stock market or on any of these indices on trading on a large scale, because the market and these indices already average everything out. They average out any events, any changes in inflation, any changes in rates that are changed by the Fed. Everything's just kind of already averaged in, and you can't really predict these moves because the price already reflects them. So you can't have an edge on the market. So this was his major, or his number one tenet, although it isn't exactly applied to cryptocurrency trading in individual stocks. This is only related to those overall indices. So he's basically saying if you're an active trader, you might not have the best results if you're trading with an indice. But obviously for individual stocks, individual cryptocurrencies, for what we are going to be working on and what we're going to be trading, it's not actually going to affect that. We're only talking about those averages and those indices. So the second tenet is that the market has three different trends, but this is in terms of time periods. So there are actually more than three trends, but this is what he said back in the late 1800s. He says there's the primary, the intermediate, and the short term. And you could actually compare these to tides, ripples, and waves. So if you think about the ocean and try to compare that overall, it's a good metaphor for the time periods of stock market cycles. So we have tides. There will be high tide and low tide throughout the day. We will have a very large movement in the level, or the level of the ocean. So at the end of the day, it might be super high. At the beginning of the day, it might be super low. Think of these as your primary trends. Now, primary trends classically within technical analysis are very long time frame trends. So think 1 year to 10 years. And then we have intermediate term trends. That's something less than 1 year, but probably more than a few months. And finally, our short-term cycles and our short-term trends are going to be very tiny ripples within those waves, and those waves make up the tide. So think about it as almost like a cascading formation. We have our tides, which are going to have the largest effect on the overall ocean, or our primary trends will have the largest effect on our overall price. And then our intermediate will have a smaller effect. Think of those as individual waves throughout the ocean. And then our shortest term trends, think of those as ripples. So just tiny little changes over time. We'll see tiny little ripples during a wave or during an intermediate term trend. We'll see intermediate term trends throughout a long-term or primary trend. There are longer term trends, longer than the primary, and there are shorter term trends, longer than the short term. But this is all Dow theory. This isn't new trading. So there are going to be very short-term trends now that we have access to something like the 1 minute chart or the 5 minute chart. That's not something that was used. We didn't have, online charts back in the 1800s. So it's a little bit more general in explanation. Finally, we have major trends actually have three phases. So there's the accumulation phase, the public participation phase, and the distribution phase. And this makes the most sense whenever we look at, I can actually switch over to the chart real quick, and we're going to look at the very long-term chart for something like Bitcoin, because we have the accumulation phase, which will be kind of what it sounds like. People are accumulating money. Maybe there's about to be a big move. And this is actually where the smartest and most acute investors tend to enter. So before a bull run, we have accumulation of coin by the smartest and most astute investors. And then we move into the public participation phase. So public participation phase comes after accumulation, after those acute investors have already bought most of their coin. And now we're seeing most traders, people that are actively looking at charts, actively checking cryptocurrency or stock news, they're starting to get into the coin or start to enter and join in on the bull run. we'll usually see some good price movement start to form. So we have accumulation is kind of right before that price movement starts, right before we see the expansion into that bull trend. And then public participation is right in the middle, right as that bull trend is kind of in full strength. And this is whenever business news sites or business newspapers will start to make comments, make news stories about this rise in price. Maybe they'll predict that this bull run is huge or the bull run will continue. And finally, we actually have what's called distribution, which is almost the opposite of accumulation. So distribution is kind of that rounding top whenever we're going to start moving back down and most likely enter into a bear trend. So we see public participation, all the business news sites are talking about this big bull run, and then we have distribution where every single news site will be talking about the bull run. So think end of 2017, beginning of 2018 for Bitcoin and cryptocurrencies. That beginning of, or January of 2018 is whenever we're seeing that distribution phase, when the smartest investors are identifying this period as top. Maybe they're using sentiment analysis and realizing that every single news site is saying that Bitcoin has to move up further because we've already moved up to 20,000. There's no way we're not going to move up to 40,000. And when everybody's mindset is stuck on the exact same theory or the exact same thesis, we're most likely going to see the opposite happen. And those most astute traders during this period of time will actually begin to sell off their positions, their long positions, and maybe even open up short positions. So to go through it one more time, accumulation, we see the most astute investors start to build up and enter long positions. Throughout the public participation phase, this is when I would usually enter as a trend following trader. Now that the trend has confirmed towards the long side, open up a long side trade, and most traders will actually enter, or most active traders will enter during this phase. And finally, we have distribution. This is most likely when the public will enter. If you see your grandma or your uncle that doesn't really know about computers start asking you if you should buy Bitcoin, or start telling you that he already bought Bitcoin, this is most likely the distribution phase, and we're about to see a reversal back into a bear trend. So the most astute investors will have already closed out all of their long positions, start opening up short positions. At this period of time, I would most likely try to exit my long position and then wait for a confirmation back towards the downside. Not great at predicting reversals. That's really those big institutions that have access to all that news and all that data. They're going to be able to do that best. So D, or tenet number 4, all averages and indices must confirm each other regarding global bullishness or bearishness. So think about the NASDAQ, the DJI, and the S&P 500. If those have all begun to turn down and drop, 8%, 10%, 15%, huge drops, we actually have to see all of those confirm each other. So if we see the NASDAQ turn down 8%, which would be insane, but the DJI and the S&P 500 are actually up like 3%, then we're not fully confirmed for global bearishness. We actually have to see all of those indicators, all of those indices, all of those averages align with each other, and then we'll be actually confirmed. So we can actually apply this to something like cryptocurrency and the largest coins, because Bitcoin and Ethereum kind of act as indices in themselves for the entire cryptocurrency market. They have a large pool and a large sway over the smaller cryptocurrencies, and we usually see movement or price action for those cryptocurrencies as leading indicators for any type of price action for those altcoins and for those smaller cryptocurrencies. So if we see Bitcoin turn down and Ethereum turn down and Cardano turn down and XRP turn down, then we can almost use those as averages, because those are the largest cryptocurrencies with the largest market caps, largest trading volumes. They almost act as averages. We need to make sure that everything is turning down in order to confirm that we are in a bear trend, or you confirm that we've come down enough to confirm a bear trend within Bitcoin. Make sure you do that for both Bitcoin and Ethereum and some of those other coins as well. Anything that would act as an average, any large market cap cryptocurrency. Greetings, everybody that is joining. Good morning. Good morning. Finally, we have E, or number 5, and that is volume must confirm the trend. And we actually use this within the trend following strategy. Volume as an indicator is only second to price itself. What that means is that volume is actually very, very important. What Dow says is that price is the most important indicator to determine if we're in a bull trend, a bear trend, which phase of the trend we're in, whether that's accumulation, public participation, or distribution. And the only thing second to price is volume. Sorry if I didn't word that right. but volume is the second most important thing, only second to price. So whenever we look at our volume, just in general for trends and formations, whenever we're about to break out of a trend, or basically, so I'll just kind of explain volume for formations real quick. Over time, we'll see a formation, maybe it's a triangle or a wedge formation. We're basically seeing a tightening of volatility, a tightening of price action range. Over time, we should actually see volume drop. So as the formation becomes more volatile or less volatile and closer together, tighter, we should see less volume. And then whether we break out from that or break down from that formation, we should see an expansion of volume. So if we break out from that formation in the bull direction, we should see a big volume stick at the bottom of our chart. If we break down, we should see a big red volume stick as we confirm that breakdown. And you can actually show that, or I can show that on the chart real quick. So we're going to add this to the stream, and I'm going to move over to that just to show you guys how volume actually confirms trends. So we can look at our trend right through here, and I'm going to zoom in a lot because I know the chart is actually kind of small when it appears on your screens. So we're going to zoom in real tight. This is actually the daily candlestick time frame for Bitcoin to US dollar on Bybit. So whenever we're looking at this formation through here, or basically what acted as a reversal, a nice little, what almost looks like a rounding bottom, but we do have this little V formation through here. So it's kind of a combination. I would just call that a confirmation whenever we move above, right around 31,765 is our first confirmation. So a second confirmation through here, 32.8. But that's not really what we're looking at. What we're looking at is volume down through here. So I threw my volume indicator on the chart. You can do that. So I can remove this real quick. If you're using TradingView, click on indicators, type in volume or just VOL. And now we have volume on our chart at the very bottom here. And you can move that up and down. You can change how that looks throughout the settings. But as we break out from this formation or this reversal and this rounding bottom, we see an expansion of net buy volume. So the volume indicator, as we see here, will always be net. So that means that we have a larger amount of buy volume or a larger amount of buyers than sellers, or buy orders than sellers accumulated in the amount that they're selling. Basically, we have more buy volume than sell volume. Throughout these green candlesticks, these green bars down through here, throughout the red, we have net sell volume. So there is more sell volume than buy volume. And this is the net. So this is subtracted out of all of the green volume. This is what we have left. So let's move back to that presentation. And basically what you can see is that we see that expanding buy volume as we break out from this formation and continue that reversal. So back to the Dow Theory slide, we have one more tenet. And I know it's hard to track all of these. You'll just kind of maybe print one out or print this out or just read through it. You don't need to follow every one of these exactly because they're not entirely relevant to cryptocurrency trading. They are more relevant to general market psychology. So it's really something that sticks in the back of your mind rather than the front of your mind when trading cryptocurrency. So F, or number 6, a trend is assumed to be in effect until we see a definite signal that the trend has reversed. So think of this like a law of physics, where an object will stay in motion until we see something push back in the opposite direction, or we see something push back enough to either reverse it or stop it entirely. It's the exact same for a trend within the stock market or within any type of tradable asset, also within cryptocurrency. So I will really get into this whenever we get into the psychology of trends, but let's move back to that chart. So basically what we're seeing is anytime, oh, actually I need to move over. Anytime we are seeing a reversal in the trend, so we actually saw a bear trend throughout this area through here, and then a bull trend through here. We saw a reversal right through here. By seeing that reversal, we now know that there is enough of a push from the buy side to counteract the entire volume of the push from the sell side. So basically we had more buy volume than sell volume. That is reflected within our volume indicator at the bottom, but it's also reflected by our price. Anytime our price moves higher and we see these green candlesticks, and I am going to go into this in more detail on the next slide, we see more buy volume and more buyer pressure than seller pressure. Basically, buyers win whenever we see that push higher. So let's move back to that next slide, and we're really going to get into the psychology of these individual candlesticks and the individual trends. So I call this slide candlestick psychology. First, let's go over the quick anatomy of a candlestick. This has just a few little things: the shadows, the body, and time frame. And I'll really get into that. We'll zoom in real close to look at just one candlestick. So let's really zoom this in. Let's look at this big green candlestick right through here. This big green candlestick that really pushed us and confirmed that reversal once we saw that daily close above our previous high based on these closes through here. So this is a candlestick. A candlestick will reflect a period or price travel within one period of time. So the period of time is what you select for your time frame up through here. Right now it is 1 day. So this is the absolute and total price action for July 21st. We have the open and the close. We have our top side shadow, our bottom side shadow, and just the body of the candlestick in the middle. So we refer to all of this filled in area as the body of the candlestick. The bottom for a bullish candlestick or a green candlestick will be the open, and the top of that right through here will be referred to as the close. These little whisker or wick looking things, if you think of it as a candle, that would actually look like the wick part on the top side, and maybe the wick pointing through or poking through the bottom on the bottom side. These are actually called in technical analysis called shadows, but a lot of people just refer to them as wicks. Again, using that metaphor with candlesticks or candles themselves. So shadows on the top, shadows on the bottom. We won't always see a shadow on both sides. Sometimes we'll only see a shadow on the bottom side or on the top side, but most of the time we will see at least small shadows on both sides of the candlestick, on the top and the bottom. So anytime we do see that bullish candlestick, or what ends up being filled as a green candlestick, we have the close on the bottom side, or the open on the bottom side, excuse me, and the close on the top side. So this means that whenever this day ends, or July 20th ends, we form or open a new candlestick at that same price, or the same price that we closed at through here. So you kind of have to understand how this preceding candlestick works. First, this is a bearish candlestick. We actually opened at the very top through here at 30,810, and we closed down through here. So we closed lower than we opened. Therefore, we filled in as a red bearish candlestick. So over time, within this day, we actually saw an open at 30,801 and a close at 29,746. But these are only the prices that we started the day at and ended the day at. These aren't prices that, we could have traveled higher than our open and our close, and we actually did. That is reflected through our shadows. So throughout the full day of July 20th, we saw price action and price travel all the way up to the top side of this top shadow, which is right around 31,033. And we saw price action all the way down. Our absolute minimum was right around $29,283. The body of the candlestick only represents the difference between our open and our close. That is applicable for both bullish and bearish candlesticks. So the body of the candlestick reflects the difference in price action between when we started this day and when we ended this day. The shadows represent the absolute max price that we reached and the absolute minimum price that we reached throughout that same day. So back to the presentation. I just want to see if I'm missing anything from this. So bullish, green candlesticks, buyers push the price up. So that kind of goes back into whenever we were talking about volume. What we actually saw was, let's move back to that. What we actually saw was buyers winning this day. So throughout this day, we actually saw sellers winning this day. So sellers were able to successfully push the price down and allow the price to close lower than it opened. So any of this price action that we see, especially with the body of our candlestick, you can think of it as buyers winning or sellers winning, buyers losing or sellers losing. Whenever we see a bearish candlestick, sellers had more control throughout that day. They were able to provide more volume, more sell volume specifically. Whenever we have a bullish candlestick, the buyers were able to provide more buy volume. So they were able to win out if you were thinking about a competition of whether the buyers or sellers have more money to throw either at or into Bitcoin or against Bitcoin. So the sellers are trying to sell off as much Bitcoin as possible, and the buyers are trying to buy into or buy as much Bitcoin as possible. Whoever wins will be reflected by the color of the candlestick. Green means buyers win, red means sellers win. So this really gets into the intricate psychology of candlestick and candlestick analysis. This is why people that trade using Japanese candlestick formations, which will be, you look at 3 candlesticks or 5 candlesticks, and you say, all right, that represents a certain predictive price move. And because we saw that formation of 5 candlesticks that look this way, we're most likely going to push up because we really understand the psychology of what buyers and sellers are thinking at the moment. But you really have to get into each individual candlestick and then layer those together to actually make those formations. And then if you think about larger formations like a wedge or a triangle or a trading range or rounding top or rounding bottom, this is really just a collection of the individual psychology of every one of our candlesticks. So hopefully that makes sense. If you guys do have any questions about the specific candlestick psychology, we've got a few more people. Greetings, Splashfire Films. Greetings, Labas or Labis. 5:52 p.m., right around 6 p.m. from Lithuania. Thank you for joining in from Lithuania. And Odessa, Ukraine. Hope you're doing all right. Thank you for joining in. I really appreciate that. So let's move back to the little pitch deck or the little slide deck. And like I just said, series of candlesticks do create trends. So the psychology kind of adds up to create an overall trend, and you get a reflection of that in how the trend itself looks. So next we have support and resistance psychology. This is really one of the main tenets of trend following strategy and the trend following theory. Everything going back to turtle trading, what I explained in that first video. Good night, Sunny. I see you're clocking out. Thank you for joining in for as long as you did. But let's really get into this. The basis of support is a concentration of demand and resistance, a concentration of supply. So whenever we draw a support line on our chart, that support level is reflecting the large concentration of demand. So a lot of people want to buy at this price level. Next, we have resistance, which is a concentration of supply. So a lot of people want to sell at that price level. They got a lot of Bitcoin, they got a lot of coin, and they want to sell it off whenever the price hits 50,000 or whatever our resistance level is. Getting back into the deeper explanation or the deeper definition of support and resistance, support is buying sufficient in volume to halt a downtrend in prices for an applicable period. So that goes directly back to Dow Theory. Buying sufficient in volume, enough buying volume to halt the downtrend in prices for an appreciable period. So we see a bear trend or just a big downtrend in prices. We need enough buying volume to counteract all of that seller volume. And it's the same on the flip side for resistance. Resistance is selling sufficient in volume to satisfy all bids and hence stop prices from going higher for a period of time. So let's say we're in a bull trend where we see all this buy volume pushing us higher and higher. But once those sellers have enough sell volume, sufficient in volume, to counteract all of that bull volume, all of that green buy volume, then we're actually able to reverse. And that area where we're able to reverse is referred to as resistance. And whenever we're drawing support and resistance lines on our chart, we're actually predicting levels in which either buyers or sellers will have that sufficient volume to either turn the price around or at least hold off on price movement for a while. So a support or resistance will actually reverse its role when the price level is broken. I personally refer to these as support and resistance flips. I'm sure there's other ways to refer to them as well. I can show that on the chart real quick because it is very important for the trend following strategy and just general horizontal support and resistance. So let's find a good level on our chart where we saw a really nice support and resistance flip that's nice and obvious, nice and clear. Let's go ahead and zoom out. I zoomed in really far to show those individual candlesticks. Maybe something right through here. I like this area. That makes a lot of sense, and it's nice and long term, so it looks really good on the charts. And we can actually remove this other line, should we? Or is that a better example? We'll get into that in the future, or towards the end of this video when we do some analysis over Bitcoin and maybe Ethereum, some of those other coins that you guys recommend. So support and resistance flip. Right now, through this price action through here, we are seeing resistance at this level. I like to draw my resistance levels as red. We can make this a lot thicker so that everybody can see. And let's zoom in. So we have a resistance line drawn at $40,730. What this means in terms of our price action is that there is that sufficient sell volume to push us down every time we try to approach or even break through $40,722. But once we are able to break through that price level, what we see is a flip of this area. It no longer acts as a resistance. So now that we've broken through, we break through right through here. So I can actually draw. So we see it act as a resistance through here, as a resistance through here. Here is that inflection level whenever we have flipped from being under that resistance to above that resistance. Now that we are above, what we can actually do is change this. I like to draw my supports as yellow lines. We'll actually see this price level now act as a support instead of a resistance. So the way it acts has flipped, hence support and resistance flip. So we see that exact same price level. It's not always exact. It really depends on the chart and the volume we see. Sometimes we see a little bit of slippage, but based on our closes, so our top side closes, we never saw a close whenever it was acting as resistance. We never saw a close above right around $40,456. But whenever it flipped into support, we never saw a close below right around 70,000 or 40,766. So it's about that same price level. Again, it doesn't have to be exact. You're not saying that we have an exact support and resistance flip at $40,000 flat or $40,700 flat. We are always going to see just slight variances in volume, slight variances in price action, and the way we affect those price levels or these support and resistances. So sometimes we'll actually see our shadows approach this level like we see through here and touch that level. Sometimes they break through like we see through here, but we never see our closes or the bodies of our candlesticks break above this level until we do. And once we do, we now see it flip into acting as a support. And now we don't see any closes below that price level because it's acting as a really nice support for this level. And what we see through here is actually called slippage, or I refer to it as slippage. I think most people do. And that's when we see our closes and our candlestick bodies actually push through that price level. But in the future, we still see that price level act as a support or resistance. So basically what we saw was a ton of indecision, a big battle between buyers and sellers throughout this entire area as we attempt to push through this level. We saw what we call a mini false breakout or just a slip through here. We come back down, buyers regain control, and on their second attempt, push through really nicely through that resistance. And we now see all of that price action above that level where we traveled to right around, let's see, where's that? 50,000, 51, 52,000, something like that. So that is what looks general support and resistance flip looks like. I can throw some more examples on the chart as well. I hope there's an Indonesian translation so I can understand. I will actually look into that because this video or this live stream will be put on YouTube and anybody can watch it if like you missed the first part or something. So I'm going to look into the closed captions and see if there is an Indonesian option for you. Support and resistance, I know the theory. Let's see the theory, but to trade using support and resistance, nope. I'm more at ease with using indicators like the Ichimoku cloud. I get that. You know, everybody has something that really works for them. You know, whether you spend more time researching or actually trading with the Ichimoku cloud, you're most likely going to be a little bit better at it. And I'm personally not very good at the Ichimoku cloud. I've tried to use it numerous times, but I really like horizontal support and resistance, the trend following strategy. It's been working for me. So finally, we have potential support and resistance levels. So where could we find support or resistance on the charts? Now, we could probably find it just about anywhere, depending on where we saw previous support or resistance. But just in general, where do we usually see support and resistance? We usually see it at previous highs and lows. So think about peaking of Bitcoin at $20,000. That's going to act as a resistance, or as it acted as a resistance at that time. Once we break above that level, or we did break above that level, it's now going to act as support if we ever come down to that same level. Next, we have round numbers. I call these psychological support and resistances. I talked about this last week for something like ADA Cardano and XRP that have prices, you know, around the $1 area, between 50 cents and $2 or so. We actually usually see a really strong psychological resistance. It can act as a support or resistance, depending on if the price is above or below, at right around $1 flat, because when people are holding on or buying into or selling out of ADA Cardano, they look at the price, maybe it's $1.50, and they say, all right, if I'm going to short, maybe I should sell out if it ever goes below $1. People like those easy round numbers, and that's why they're called psychological support and resistances. Next, we have trend lines. Trend lines means not necessarily horizontal support and resistances or horizontal trend lines, but any type of trend lines. So if we see a wedge formation or a triangle formation, and we see that nice little, you know, top side resistance that we can't push above. Maybe in the future, if we come back to that same trend line, if that trend line is extended, we haven't hit that price level yet, that may just act as a support or resistance. Next, we have price gaps. We don't usually see these on cryptocurrency charts. They're much more common on charts with intraday trading on something like FX, although FX does have 24-hour volume depending on where you are. Maybe something like stock markets, very common in stock markets, where our price will close at something like 4 p.m. New York time every day and then open back up the next day. So what we actually see is we could see news, we could see price action, we could see just the general economy either booming or tanking, and that will affect the price of those stocks while the stock market can't actually reflect it yet because that candlestick has closed and we don't see 24-hour reflection of those price levels or of those changes in price. So let's say we have a stock that's at $1.20 the day before, and then we see some big news about this company has released, got FDA approved. It's a pharmaceutical company. The next day, we actually see it jump up and open the body of the candlestick is something like $1.50. So we close the day before at $1.20, but the very next day, as soon as that new candlestick is formed, we open at $1.50. There's a gap between our close the previous day and our open the current day. That's called a price gap. We can see those on cryptocurrency charts, especially, but not very often, especially on the lower time frames or the very tight time frames, like the minute chart or the 5-minute chart, whenever we don't see enough orders, or basically we see a jump in orders. So between the time that our current 1-minute candlestick closes and our next 1-minute candlestick opens, we actually see a jump or a gap in the order book. So there's not, it usually happens whenever we don't have a lot of volume for those specific coins. So think of lower market cap coins. We most likely won't see, or very rarely will see, gaps on Bitcoin, Ethereum, and those high market cap coins. Finally, we have Fibonacci retracements and extensions. So my favorite indicators that I use all the time to trade and to determine support and resistance flips, potential support or resistance levels, especially whenever we don't have previous price action at that area or at those levels. I think if you guys are down for it, next week we can go into Fibonacci retracements and extensions, because I think that is very important to trend following strategy. So anything else? Hello, Zolfami. How's it going? Hey, Kilo. Glad to have you in here. And just so you guys know, all of this about support and resistance psychology, I've written it out before and kind of a breakdown of all of these theories, but it does come from Technical Analysis of Stock Trends by Robert D. Edwards, a fantastic book that I will talk about in just a second. And the slide before, all of the Dow Theory stuff comes from Technical Analysis Explained by Martin J. Pring. And I did get some questions last week about some good books and some good text to read to learn technical analysis and the psychology of trading. And that's what we're going to go over next. This is the fun part, at least for me. It might be incredibly boring for some of you guys, but I love my books. I love my trading books. So let's go ahead and get started with Technical Analysis Explained by Martin J. Pring. That one is right here, TA Explained. I kind of consider this to be, I call it the Bible, because this is what I go to first if I'm looking for a concept or theory and I want the correct facts. Very factual, but it's also great for beginners, and that's why I listed it as a great starting out book. If you guys are read any books for trading as well, and you guys have any recommendations that I could check out, go ahead and drop those in the comments as well. Next, we have Trading Psychology. There's 2 versions of this book. The first one is called Market Wizards. It's by Jack D. Schwager. It looks like this, and he actually interviews, I think, like 30 different traders. Maybe it's 25 or 30 different traders that have the best performance records of all time. He spent a long time getting sit downs and interviews with all of these different traders. Either they manage funds or they are personal traders. Usually they manage funds or manage other people's money, because that's really the test of if your trading strategy works, rather than just trading with your personal funds. And he just goes and asks them every question he can find or he can think of about their trading mindset, about psychology, really what we're talking about in this live stream. And there is actually a second book. There's a second version, an update. I don't actually own that one. I just have a PDF of it. You can probably find PDFs of just about every one of these books. How's it going, Ampo? How's it going, Exchange Pro? Next, we have Intermediate Theory. My textbooks of trading. you'd think there's no textbooks, but if you wanted to make a class, like a lecture about trading, which is kind of what I'm trying to do here, these are some of the textbooks that you would probably provide students. Next, we have Technical Analysis of the Financial Markets by John J. Murphy. I consider this the dictionary or the encyclopedia, because if there's anything that I need to know more in depth about, Technical Analysis Explains gives you that good starting off point, that good jumping off point. But if you really want to get into it, this is a little bit denser, a little bit harder to read, which is why I classify it as intermediate theory. Technical Analysis of the Financial Markets by John J. Murphy. Check it out. Again, there's PDFs of all of these probably online, or you can go to the library. They might have them, because these are very, like, just buying these books, it's ridiculous. They're like $70. Next we have, and finally we have formation reference. So if you want statistics about how often formations actually work out, specific formations, so I can actually flip through this real quick and find a good example. It gives you just absolute a litany of explanations, statistics, examples of formations and how they perform. So here we have an example on chapter 45. This is three falling peaks. So the three falling peaks formation. We have, let's see, the average decline after the three falling peaks formation is 17% in a bull market or 24% in a bear market. So what you can actually use this for is to test your trading theory if your trading theory is based on individual formations. So you look at it here and maybe you say, all right, the average decline in a bear market, it says 24 versus a bull market 17. So maybe if I'm setting a sell target in a bear market, I can let it go a little bit looser. I can set a bigger sell target. And next we have, if we're in a bull market, maybe I should set it a little bit smaller, make it a little bit tighter. It just gives you a good general idea. Obviously, this is all based on stock market patterns. Actually, every one of these books are based on stock markets, but we do use the basic fundamentals and even some of the intermediate and advanced theories of technical analysis as it's applied to stock markets. We apply it straight to cryptocurrency, and we just tweak it a little bit depending on, over time you say, all right, XRP doesn't always hold that psychological resistance at $1, but it does hold at $1.05. So maybe it's not a perfect psychological resistance, but we tweak it just a little bit because it's a cryptocurrency. Crypto's got to be different. Can you write the title of the book in the comments? Sure. I'll make a full list of all the books. I think that'll be the best way to do it. Whenever we finish this, let me write that down. Whenever we finish this video, I will go ahead and drop just the titles. I'm sure you can find these online as well. So books, I'll pin it as a comment in the VOD. All right, so let's get into some technical analysis. I know that's what everybody's been waiting for. That's what I've been waiting for. So we're first going to go through those two requests from last week, AVAX and XRP. I hope the guys or girls that requested these are in and watching this week so that we can actually get into these and you can see that analysis. So first we're going to start with AVAX Avalanche, and we're going to check out if there's any opportunity for application of the trend following strategy. So let's find AVAX. Let's do AVAX to US dollar tether. Maybe next week I can also talk about, we'll cover Fibonacci extensions and retracements, and then we should talk about, a good idea, we should talk about, excuse me, the coffee's coming back up. We should talk about the difference between pairs. So trading against like a US dollar tether pair or a US dollar pair. So trading against a fiat pair versus trading against the Bitcoin pair. So that goes a lot into individual strategy and individual price movement, basically how it looks. And how you can kind of change up your strategy based on if you're trading against US dollar or if you're trading against Bitcoin. There's also a little bit of calculation you have to do. And if you're trading against Bitcoin, thing is, you got to track the pair and you have to track the Bitcoin price. So it's much more complicated than just a regular US dollar or a spot pair, but we will go into that because it can be very advantageous. I made some of my best trades. I have made my best trade specifically on the Doge to Bitcoin pair. It's my favorite pair of all time. But let's go ahead and take a look at AVAX. So first, I would actually like to talk about just the general trend. So let's go ahead and draw that. What we're looking at right now, we're actually seeing lower highs from the top side through there, but actually maybe we're seeing a nice breakout. I'm going to draw it through here because this makes the most sense to me based on the two peaks we've seen so far. It's not a perfect confirmation because we've actually already seen, we've only seen two touches to this price level. I like to see three. But what we're going to do is whenever we're drawing these trend lines, especially whenever we're drawing them to determine our trend and you're not drawing them horizontally, we want to make sure that you are always drawing these with the body not sticking through the trend line. So if you drew it like this, that would be very incorrect. That's a big no-no. If you drew it like this, that's fine. If you drew it a little bit higher, that's fine as well. If you draw it based on our top side shadows, that's perfectly fine. But just make sure that you never have your bodies sticking through. That's a big no-no. So let's just draw it like that. It doesn't need to be perfect. We're not trading based off this or trading based on this price level. We're just determining our overall trend. And what we've seen so far, that we do have lower highs from our trend that we may be breaking out of, but we don't know just yet because we haven't really gotten into it. So next we have actually a couple individual trends. What we maybe have is a nice little sloppy, as I like to refer to it, well, actually there's two ways we can draw this, and one way, so this would be the first way, which is going to be on our absolute lows. Make sure we don't have the closes sticking through. That would be our bottom side. We're seeing lower lows. Now there is a second way, and you guys might hate me for this because it's going to change, or not change, but it's going to violate what I just said. So there are very specific circumstances, and most likely you won't see this, very specific circumstances when you can actually draw a trend line with our candlesticks breaking through or pushing through. And I know I said it's a big no-no, but there's one circumstance, and it's this circumstance when you can actually violate that. And that's when we see that same trend line actually acting as a resistance whenever we push back up, or acting as support whenever we push back down. And what this is called is a whipsaw or a false breakdown. So what our actual trend is this, or this line through here, is our proper set of bottom side supports for this formation, but we saw a false breakdown here and here. So this is a very rare circumstance, and it's unfortunate that I'm explaining it for this chart. But what we actually see is what looks like a breakdown, what looks like a big confirmation, a perfect confirmation that we're going to see a short side move, and we can open up short side trade from whenever this candlestick closes at 70, and we can set a nice sell target at 64.8 or 65 exactly. But we actually see enough buy volume to push us straight back into our formation and actually return to the exact same formation with those same resistances and same supports. Same through here, although this is less of a whipsaw or a false breakdown. This is actually more of just slippage. So what we see is just a slight breakdown and a slight pushback up, just to return. So that can be just like a very minor whipsaw or a minor false breakdown. And we actually see these more often than we would see something like this towards the very end of our formation. Now that we're seeing such a tightening of volatility and all of this huge buy volume on the breakout, this is most likely going to be a very confirmed breakout towards the long side. Not to speculate on our continued price movement or to say that you should buy it. Obviously, do your own research and make your own charts as well, and make sure that you have your own personal reasons, because following other traders doesn't really teach you a lot unless you go ahead and apply the lessons that you learn to your own strategy and make sure you can use those over time. You know, teaching a guy to fish versus giving a guy a fish. And that's what we have right now in terms of horizontal support and resistance levels. I would actually draw this as a nice inflection level right through here based on our previous breakdowns. Let's make this way smaller, way skinnier. This is what we have at the moment as resistance. If you're looking for an intermediate term, or really a short to intermediate term confirmation, almost an inflection level for the continuation of this breakout. Same circumstance as what we saw through here, but we are actually seeing this breakout and all of this price movement, all of this volume that's cascading at the very end of our formation, where we're seeing really tight price action, really tight volatility all through here. So this is most likely going to be the proper breakout, or yeah, proper breakout has to be, because it's towards the long side for this formation. So that's what we have for AVAX at the moment. In terms of long side resistances, we can see if there's anything looking good on the chart. Do let me know in the comments if the chart is too small and you can't see it. I can actually change up the view in just a moment on the stream. So let's go ahead and look for any type of resistance towards the long side. We have this area through here, which gives us a couple confirmations, not perfect confirmations like we see through here, a lot of slippage. It would actually incept right through this area, maybe a little bit higher than that. We have alignment based on our top side closes through here and our bottom side shadow through here, top side shadow through here, and I actually like that level. I like that level as a sell target, or actually as a resistance, not a sell target. What we would do is we would bring our sell target, this is going to act still as our resistance, but we're going to set a sell target, not bring our sell target, just a little bit lower than that level. And what that's going to do is, and as I explained in the last episode, is it's going to separate us from other traders that are looking at this exact same chart and saying, all right, we're confirmed for the breakout. Let's go ahead and enter a long. Let's set our sell target. All right, we've got perfect alignment through here, right through here at 91,305. I'm going to set my my stop sell, or I'm going to set my limit sell targets. Now, what we do is we beat out those traders in case we see a cascading or a domino effect at that price level. Everybody sells out at the same level, same time, and you don't actually get your sell order filled. We make sure that it gets filled, or increase the probability that it gets filled, by setting that sell target just a little bit lower, almost like undercutting them. Think about it as, if you're selling gas for a couple cents less than the guy next door or the guy across the street. So next we actually have XRP. Let me change the view just so you guys can see a little bit better. It's a little bit more zoomed in. Let's take a look at XRP. Let's find it first. This is what I get for not putting these symbols in order. We can actually order them, but I see it. If you guys are using TradingView, just another tip, you can click this up here to sort by symbol, sort alphabetically, to sort by our price. So Bitcoin would be the highest, and then we go all the way down to those tiny, very cheap coins, or low price coins. Change in terms of absolute value, and then change in not absolute value, change in terms of difference in value, and then change in terms of percentage. So lots of ways you can look at your favorites list. This is my favorites list for Bybit at the moment. I believe it's every Bybit pair. Looks like BTT actually must have gotten delisted. Must have seen a big drop in volume. So let's go ahead and take a look at XRP. It's currently sitting at 97 cents on the dot. This is the daily candlestick time frame, XRP to US dollar tether on Binance. We've got 7 hours and 17 minutes left until that candlestick closes. Again, going back to what we talked about at the beginning of the stream. What I'm going to do first is, because I just love setting these psychological resistances, set one right at $1. It just makes sense to me. We can actually set one closer to 50 cents as well. So let's find that exactly, 50 cents, 49.999. That works as well. And you can see how our price action reacts to these psychological supports and resistances. Again, applying what we just talked about to the current chart. I love it. We've got one at 50 cents. We actually see approaches to that level based on bottom side shadows at 50.5099 and 0.5167. But because this is just a general level, and we actually see a nice amount of buy volume pushing us back up, not letting us exactly hit that level, exactly hit 50 cents. What we would call this is an approach rather than a confirmation or a touch, but approaches can act as pretty good confirmations just in the future. So whenever we see the price level not necessarily touch that level, but it comes nice and close, like we see through here, just off by 2 percentage points, we would call that an approach. That would still act as a pretty decent confirmation. So towards the $1 side, and this psychological support and resistance flip, and it is a flip because we've seen it act as both a support and resistance from both sides of the chart. So let's look for some good examples of it acting as a support or resistance, and then we can look at some examples of it not acting as well as a support or resistance, and we can kind of see what we would like to say about that, or kind of determine if it actually is a good support or resistance. So we show every example. Basically, we have nice little close through here, basically a slowdown or a bump on the way up through our bull trend. We actually see a nice slip, a big slip through here, down from $1 to 95 cents, big cascading volume, big sell off for that candlestick. Wow, that's huge. From, what is that? That's what I get for putting all these indicators on my chart. Is that $1 like 38 or something? Like we can actually see it's $1.3930 all the way down to 95 cents. That's a huge price move. What is that, 45? No, not 45%. It'd be something less than that, 35% or something. So back to what we were talking about. We've got this top side, no closes above this level. It was acting as a resistance throughout this period of time. We flip above, and now we see our shadows not going below that level. Now it's flipped and it's acting as a support. So we could actually make that yellow if we were within this current period of time. Yet again, it's still acting as support. We haven't closed below that level. We do see a close below the level through here, but it looks like we have decent volume, but we don't have a good confirmation. We actually see just a slight push below. So again, this is called slippage. Whenever we see a slight push below, but it doesn't actually confirm that new trend, It's right around minus 9.5%. Excuse me, again, that coffee, man. It's right around a minus 1% push below and close below our $1 support and resistance flip, or what was currently acting as a support. And it's just not enough of a confirmation. So usually we see something like we see through here. So we see a push above from our base support to right through here. We see a close at plus 3.89%. And what we call this is percentage-based confirmation. So if you do see just a slight close below, maybe wait and see what that next candlestick does. If that next candlestick pushes even lower, and now we've seen a candlestick close by at least maybe 2% below our support or 2% above our resistance, it's probably a better idea to enter then, or wait until we've seen just a little bit more of a close above or close below. Negative 0.95% is a little bit low for me. I personally wouldn't enter that. I'd wait till we see just a little bit lower of a push. And we actually see that work out really well through here, and I'll talk about that in just a second. So we actually have slippage through this area, which we should always identify. But because we do see it act as slippage, what we can do is, especially in these formations where we see these tweezer bottoms, like we see through here, this is called a tweezer, because we see these two kind of very full candlesticks, these full bodies right next to each other. We can actually push up to something like here, and this would be our new support and resistance flip. We actually wouldn't see our support act as or identify as this area at 0.99. We'd push up to our next area, kind of where we started out at. So basically what we do is we say, all right, we saw this tweezer bottom, but it was very short. It was very temporary. So let's kind of ignore it as our price level moves back up. So next we see these bottom side shadows through here. Not seeing any shadows push through this level right at $1. But once we see that close below that level with enough percentage-based confirmation, so what we saw was from $1 to these closes is 6.29%. That's tons of confirmation. And we say, all right, we are confirmed towards the downside now that we have a nice confirmed psychological support and resistance flip. We've seen all of these examples of $1 flat either holding as a resistance or holding as a support. We've got, let's see, going back through here, like 1, 2, 3, 4, 5 really good confirmations. All right, $1 is working really well as a support and resistance flip. We go ahead and open up that short side trade, and then we say, all right, if we're going to set our stop loss, we got to set it above $1, because if we ever come back up and push up against this level, then we should hold it because it's held in the past. We're following that pattern. We're continuing, and we're actually making our entire trade thesis based on the identification and the continuation of this pattern. And it works out really well for XRP and for this current chart and pair, because we don't see any closes above that level for the next, we actually haven't seen one yet. So we still haven't seen any closes above that level. It's still held in two circumstances within 2 time periods. So right through here, it still holds. We don't see closes above that level. If you just set your stop loss slightly above that level because you opened up your short at something like 0.93, set your stop loss at like 1.02 or something. It's a very large stop loss. But if you're setting it for a longer term trade, so let's say like an intermediate term short, then that's perfectly fine as long as you set your sell targets, pretty low to get a good, what was I going to say? Pretty good risk reward ratio. So we come down, we see it act as yet again, it has flipped below, we see confirmation, and now it is no longer acting as a support. We can make this yellow because, I guess no. It's no longer acting as a support. It's going to stay red. It should have been yellow before. It's now acting as a resistance through this area through here. We see the continuation of this bear trend now that we have confirmed. Same as we see through here. We attempt to push and break above and close above this area. We see our shadows poke through, but we don't see those closes above. So there's no confirmation that we would move back towards the long side, even though we saw this really nice rounding bottom through here. It really would have been nice to see that long side trade. If you were on the long side, a good confirmation back above $1, especially if you're investing in it, if you're investing in XRP. And now throughout our current price action, we don't see any approaches to that area. So I'm sure you guys are like, well, what's going on with the current price action? You've been talking about historical price action for the last 10 minutes. What's going on? I want to know what's happening now. So let's go ahead and draw those trend lines. So one through here, we got to make sure we can just draw it for the general trend. And then we go ahead and manipulate it. We say, all right, we've got that through there, what looks good? Maybe something like that. Or current, what would that be? From February 24th to March 18th. I would call that a short to intermediate term trend. Now for the bottom side, we just draw it and then we go ahead and change it around. We manipulate it. We make sure we don't see any of those bottom side closes break through. And what we have is a nice tightening of volatility, but it's very slight. Think about or look at the magnitude from here to here. That's around 14.43% versus our current magnitude for our current candlestick. And as those trend lines converge, it's now 9.61. So a drop in around 5% in terms of range or our magnitude between our bottom side support and our top side trend line. And what we need to see is, and we're actually seeing that general drop in volume. So these are our volume bars down through here, like I said before, and we see a general drop. One thing for volume is, unlike drawing your trend lines, you can draw trend lines for volume if you didn't know, and we can have our volume candlesticks actually poke through our trend line. That's perfectly fine. There aren't, certain circumstances where it's not a big no-no like it is through here, except for that one circumstance that we happen to see on the AVAX chart. But we can always see, or it's completely allowed for volume. So we're seeing a general depreciation of volume over time. And what we should see, or whenever we do see that big explosion of either buy or sell volume, we should see that coincide with huge buy or sell price action. So one can come through before the other, but usually they come right around the same time. We should use price always to confirm. We should use price first and then use volume always just to confirm that price movement. So don't look at your volume first and then say, all right, we can look at our price. Use that volume or that movement in, or use that price or that movement in price and confirm it with volume. This is always, there's a certain time in the live stream whenever I just can't talk. I can't talk anymore. So let's go ahead and close that out for the price action and the chart analysis for XRP. If you guys have any requests, I'm going to do one more chart because I am running out of oxygen. I'm talking so much, but if you guys have any suggestions, go ahead and drop them in the comments down below. It's not showing me the very bottom comment. I can put that up. I don't speak. Is that Indonesian? Is that the same guy from before? If you guys have any suggestions, speak your piece now. Otherwise, we're going to get into the conclusion because we're poking through an hour for the live stream. So any suggestions in the next 30 seconds to 1 minute, I'll check those out. Otherwise, we can go through the conclusion, and I think that's where we'll close out. So I'll just start going through the final concluding remarks. So, and if anybody has any suggestions for a chart, say so now, and I'll run through those real quick. But thank you guys for watching. You can see me and my friends or my teammates, Andre and Greg, on our weekly episode of Crypto Beat. Those come out every single Monday at 4 a.m. Austin time, 5 p.m. Singapore time, and somewhere in between if you're not in Austin or Singapore. Those are really fun to make, and hopefully we do some more traveling in the future. We traveled to New York for those first 8 episodes, and we did a lot of really cool stuff. We met a lot of really cool people, kind of throughout crypto, people like restaurateurs who just accept crypto as a payment method. It was so hard to find places that would accept crypto. We did like a challenge where we tried to spend $200 in Bitcoin in 6 hours, and it was tough. We had to do a lot of calling around, and there were a lot of places that just said they don't accept it. Let's see, one more comment. We'll try to pin this real quick. All right, no more requests. So closing remarks, you can check out Crypto Beat. Thank you for the cheers, Kilo. Always appreciate you having you in here and moderating and everything like that. But thank you guys for watching Crypto Beat every single Monday. We're doing cool stuff, and we're going to do even more cool stuff as season 2 breaks out. We're currently closing out season 1 at the moment. Anything other than that, these streams will come out yet again every Friday, right around the same time they happen today. Thank you guys for joining. Thank you guys for watching. Yet again, go ahead and join the Discord channel for Crypto Beat. So if you didn't get a chance to answer your question or get your question answered, or didn't get a chance to ask your question, if you're watching this after the live stream, go ahead and go to the Discord channel. There's a little Crypto Beat tab, and you can ask your questions then, and I will read through those. I will check that pretty often. And then for next week's stream, I'll go ahead and answer those or look at those charts, anything like that. But whatever you guys want me to do, I'll check it out as long as it's appropriate and it's a good chart related to trading. But thank you guys for watching. I really appreciate it. I'm having a lot of fun doing these streams every single week. I hope you guys are enjoying viewing them and being here with me. Thank you guys so much, and please have a fantastic weekend. Bybit is the best. Crypto Warriors essay. We can close on that. Thank you guys for watching, and good luck trading this week. See you guys later.